Everybody, first off, as we always start our presentations with, we're going to get into an agenda. But before I can even get into that, because this is our first live webinar, I want to thank you guys for being here with me. I do appreciate the attention that you guys are always giving. The consistent, approach to your further learning is refreshing, and I always you can ask Riley. She's sitting next to me. I always talk to her about how I love working with you guys because everybody's always hungry. I love when we see new people come in and excel past guys that have been here for a while. It remotivates people. It's just a really good group of people that's developing, and I just really appreciate everybody growing with me, always giving me the attention, always giving me, your time, and I think that hopefully you're getting that value back. That's why you're here tonight, and that's why we're going to go over some new information. So a lot of you have had questions on this stuff, building a trading plan, talking about risk management. How do we build this risk profile that you've heard me talk about, right? It's a term that, maybe people have thrown around on the internet before. I haven't seen it being used too much, and that's why I'm kind of trying to take control of it and really help everybody, whether they're a new trader or an experienced trader, understand that having a risk profile is crucial because it's more than just a trading plan, and that's what we're going to talk about today. So the 4 things that we're going to go over. If you're taking notes, I would close Facebook, get the pen and paper out. I would try to write some things down here. I know you can rewatch it, but writing it down on paper is definitely going to help. So the 4 things we're going to talk about. Number 1 are the components of a proper trading plan. I'm actually going to show you a trading plan of mine from 2 years ago. I haven't shown this to anybody yet before, but I want you guys to see it. That way you can really understand what was in my plan. And of course, it's basically the same thing. The numbers have changed. The psychological approach in some areas I'm going to show you has changed, but the basic gist of it is the same, and that's why I want you guys to see it. You can take screenshots of it, you can copy it, whatever works for you. I want you to be able to do that. So that's the first thing we're going to touch on. Second thing is we're going to talk briefly about the 2 reasons why traders lose and how you're going to avoid them. They're very, very, very simple when you hear me say the words, but when we talk about the complexity of the psychological approach and the mental approach that goes to reasons, you're going to really see why they do grab a lot of traders and pull them down. It's almost like shooting yourself in the foot while you're trying to run forward, and we're going to talk about how to avoid that. The third thing we're going to get into tonight, kind of transition from talking about why people lose into something that's going to help you make better decisions in your trading, avoiding more losses, is going to be grading your trade setups. And that's going to build right into determining your risk profile, because once we can grade the trades, once you understand how I've been doing it, then you're going to be able to determine what risk percentages you want to build into your profile. So basically at this point, before we go any further and we talk about the trading plan, I'm assuming that most of the people here have watched the course. If you have, and that was the point of getting you to sign up before the webinar, was that you'd watch at least some of the course. So as we go through the chapter, if you haven't finished the course, if you don't feel comfortable with the beginner and advanced entry systems, and if you don't feel super comfortable with the candle formations, then some of this might be a little bit difficult to grasp, but I still want you to watch and then go rewatch those chapters as you need. So talking about the trading plan itself, the foundation of the trading plan. This is your business plan. This is what you're going to rely back to when you're not acting in accordance with what a proper professional trader would act. This is the roadmap that you're going to follow when other things in your life are trying to distract you and pull you in other directions. There's traders on this call right now. I know that we've had personal conversations with the reason that you make bad decisions is because you don't have a plan in place. When the girlfriend distracts you one morning, or the dog got loose, or whatever it is, family sick, whatever it is, distracts you. And I know that stuff is real. This is real life, reality. Those things happen. When those things distract you without a plan, you're going to make bad trading decisions. Your business isn't going to run properly. So when you have these written rules that are detailed, your entry, detailing your exit, detailing the risk management, when you have that written down, and I recommend writing it on paper and even printing it out, when you have that in front of you, you're able to not only make better decisions, but feel confident in what you're doing and actually feel like this trading thing is not so much a gamble, more like it's actually a business. So again, print it out, put it somewhere that you're going to see it all the time. There's a few components that a trading plan must have. I think you have to detail your favorite and most reliable entry signals. Whether it's a combination of the beginner and advanced systems, whether it's one or the other, I need it detailed in writing. You're going to see it in the next couple slides, how I had it written. You need it written down. On top of that, you want to have goals as far as monetary, and also you can measure it in percentages as far as, soft stops where, okay, I've lost 4% today. I'm done. I'm walking off. I'll come back tomorrow. And then also where you're going to say, okay, I'm up 4, 5, 6% today. I'm going to stop. I'm going to take this winner. I'm going to come back and try to do it again tomorrow. Having those soft levels, and I call them soft levels in quotes, because Of course, there's just like ADR, right? How we have the average daily range. That's why I call it soft, because some days you're going to go more, some days you're going to go less, but you want to have that soft barrier to control yourself. So when you are making bad decisions, for example, which happens, right, to all of us, at least once, if you're making those bad decisions, having this written plan, having these soft stop levels in place will stop you from burning an account, from blowing through way more money than you're supposed to. And on the flip side, if you're up, and you're up 5, 6, 7% a day, how many of us would take that every day of the week and come back and do it again? All of us, right? You don't want to go up 5, 6, 7% and then give it all back. So having those soft levels are very important. I think the last thing that's important about what the trading plan needs is where you're going to place your stop loss and take profit. That risk management piece, including that percentages, grading them when we talk about that, including all of that risk management has to be written down in the trading plan. Those rules that are going to reinforce the proper mental discipline should be detailed, again, in words, on paper, in front of you, especially if you're a new trader. I can't stress it enough. So this was one of the old trading plans when I first started with the old company that I was working with. This was something that I would rely on every single day. I had it printed out above my desk. You can go on my Instagram. It's still up in some of the pictures. You can see it. And what this would do for me every morning when I would sit and have my coffee is I would read this to myself, and it would remind me what the business is about. And we talk about trading, that it has to be a business a lot. And especially when we even talk about like the losses that you incur, I always reference back to that story Eric told about the cars on the cargo ship, and the business had to just incur the loss because they fell into the ocean and they were done. You know what I mean? You just incur a loss. But not only that, that's one comparison of why trading should be treated like a business. But on top of that, when you start a business, there's huge templates that you can use online. There's huge packets of information that people put together that are called business plans that detail the projections, what the business will do, who it will benefit, how it will be marketed, how it'll be sold, what's the customer service, what's the compliance, all of these things that are detailed in that business plan to see that business become profitable. And these two slides here kind of show you what my business plan was for my trading business. So it was detailed in writing as best as I could. And of course, now as time has gone on, I've changed and things like that. But I wanted to share this with you guys. So you saw the first slide. Here's the second slide. You can take screenshots of this. You can adjust it, right? Things like that. Percentages and numbers have changed, of course, and I want you to build that. We're going to talk about that at the end, your risk profile. But the gist of this is all of it is detailed. Everything is written for me, so I don't have to think. This tells me how to act. So in order to win, we all understand that you have to be able to understand why most people lose. In order to really be confident in what you're doing, I think you have to see both sides of the coin. So there are two reasons why people lose. They're both rooted in the same word, capital. And I know you're going to say, Austin, that's corny. Of course they lose capital, right? They lose money. But there's two forms of capital that are really important. First one is mental capital. You've probably heard me talk about this a little bit before, but we're going to dive into it here because I need you to understand the importance and how these two forms of capital really do go hand in hand. Your mental capital is going to be the approach that you take to the market, the psychological approach that you're taking when you show up to the market and you're doing outside the market. How balanced is your life outside the market? Are you exercising? Are you eating healthy? Do you have good relationships? Are you pushing yourself outside of business and to do things that are, going to grow you as a person? And are you constantly kind of feeling as though you are acting in the best version of yourself? That's your mental capital. Compare that to your financial capital, which you understand is your trading account, the cold hard cash that you put to work in the market. And you can also consider financial capital other streams of income. But keep in mind, and the important thing to understand here is that capital, as far as either form, is not more important one than the other. You need both to go hand in hand in order to make you the successful trader that you're trying to be. In order to make a trader that understands how to exercise proper risk management, you have to have mental capital in line and financial capital in line. And here's why. Because if you have just financial capital, this is just like the gas to your trading account. This is just your money. This is what you're putting to work every day. If you just have that squared away, but you have no mental capital to actually make good decisions with the financial capital, what do you think is going to happen? It's not going to end well for you, right? And then just on the other side of that coin, this mental capital, that's your risk management. That's the psychological approach. How well do you follow the game plan? Think of this as the wheels to your account. One can't work without the other. The wheels of a car don't move without gasoline, right? You don't need the gasoline. You don't need the gasoline if you don't have the wheels. So they go hand in hand. You need to be able to balance your mental capital and your financial capital in order to maintain this as a business over the long term. So how do we preserve the capital? That's the question, right? Like we said, they go hand in hand. You have to be able to do a balancing act of the two. So what's the key? Everyone's probably wondering now, right? What's the key to saving capital, to preserving the mental, to preserving the financial, to making it something that I can last? The best way to do that is to grade the trades. So we're stemming now from the reason people lose into why you have to grade every single trade that you take, why you can't be trying to just throw trades around, gambling almost with these ideas, right? Grading your trades is very important. As you try to grasp everything that you've learned already in the course, chapters 1 through 9, as you try to wrap your mind around that, the parameters that are in the systems are going to speak to you. You're going to start to see setups over and over again. And those setups that speak to you should be detailed in the plan. And these parameters within those setups should be used to determine your best setups, your medium, your okay setups, and then your bad, your C setups. And I grade them A, B, or C. And each one of those letters should have a predetermined risk percentage associated with that grade. So what are those percentages? And this is where your risk profile is key. I made these numbers bigger because I really want you to understand that this is my profile. For me, A setups, I'm doing 2 to 4% depending on the currency pair that I'm trading. You guys know if I'm trading GBP NZD, I love that pair. I feel confident in what I can do with that pair. That's why I'm going to hit that with something. Sometimes on an A setup, 4%. Compare that to, let's say, USD CHF. If I was trading USD CHF, even if it's an A setup, because I know that's a slower pair, I know it's not something that I'm often trading, I won't hit that with 4%. It's not worth risk. Same with B setups. We'll talk 1 to 2%. If it's a great B setup on a great pair, GN, I'm hitting it with 2%. If it's a USD CAD, Euro USD, I'm hitting it with 1, maybe 1.5%, something like that. Now the C setups, and we're going to get into the markups in a second here, but the C, I don't like to trade C setups. If I'm in a C setup, it's less than 1%. It's very, very small. Most of the time I do. Lately I've been doing well in them, but there are times where I will lose C setup on C setup on C setup, small little paper cuts, and it'll hurt you. So I've learned over time to really be careful with C setups, almost avoiding them. So when you break down the grading system, it should look something like this. A setups, nothing can be better. You've gone through the checklist and everything fits. Everything looks good, right? B setups are going to be where 1 or 2 of the parameters could be better. For example, everything looks good, ADR is good, EMAs are good, TDI is good, price action's good, outside the box, everything is good, but maybe it's overbought, right? That's something where maybe you have a B setup. Or maybe the EMAs aren't in full trend, but everything else is perfect. That's a B setup. C setups, that's where 2 or more of the parameters are out of line. It's overbought and ADR sucks. Okay, well, why are you trading it? You know what I mean? You're asking for trouble at that point because we already know too much. I assume at this point, if you're watching, you already know too much. So when you see something overbought, you see a swapping liquid 50, you see EMAs that aren't in trend, you already know that they're not the best setups. So using this grading system should really make you feel comfortable to say, you know what? I don't need that. I want those A's. I want those B's. That's where the money is. So the questions to ask yourself, these are what I would write down, if anything, you've so far. Number 1, is ADR in range? Number 2, is the Asian range valid and is it broken? Meaning we measured pin high to pin low, it's not blown out, and the candles have broken either the high or low set during that Asian range, so the range is now valid and broken, right? Are EMAs in full trend? It's another very important question to ask yourself. Is the TDI swapping zones or is that liquid 50 in one zone all day? How about, is the candle formation off a solid EMA? And lastly, is the RSI overbought or oversold? These are the questions that I always ask myself every day when I think about grading my trades. If one of these parameters is a little bit out of whack, I might still take the trade, but take it as a B setup or even a C setup, just size down, because the best trades, you know them when they're there. Everything is perfect. They exist. They're not very often, but they exist. When they're there, you got to jump on them. And when they're not there, you have to size into these other ideas appropriately, because let's be honest, guys, we use a lot of parameters in our system. You are looking for freaking amazing trades. So when the amazing trades aren't there and you are looking at a B setup because not all of your 8 parameters on your checklist are met, you still want to be able to take advantage and make money if you have the right direction, if you have the right read on that trade. So we're going to get into the markups now. We'll talk about some A setups, B setups, C setups, and then we'll wrap this thing up. A setups. These are outside the Asian range. These are EMAs are in full trend. TDI is in one zone all day, not overbought or oversold, and ADR has space. Everything is perfect. So as you can see here, this candle is off the 21 EMA, kind of completing this 5 candle formation as a pullback here. This is the 15-minute chart on CAD JPY. This candle breaks us out of the Asian range, breaks us through that initial low of day. You see kind of consolidation zone here, just breaks right through that. You have a beautiful TDI in the sell zone, EMAs in the sell zone. Everything looks good to see more movement to the downside. So again, that would be an A setup. Can't really get much better than this. And it goes over 2R. Risk here would be about 12, 13 pips, and it goes 33 pips. Okay, A setup. Another A setup here. Outside the Asian range, liquid 50 is perfect, not overbought. Everything says we should move higher. EMAs are in an uptrend. ADR had space. Your risk here, 16 pips on the 3 candle formation off the 21, and it goes 80 pips. Doesn't even break the 21. Even when it pulls back here, it actually comes back up higher, as you can see, popping back towards that 80 pip take profit. 5-1 on this thing. I mean, this is, you're probably not getting all 80, but you're taking 30. No problem. 40 pips out of this, no problem, because look how quickly it just ran up. But again, that's what A setups do. This is a 3 candle formation off the 21 EMA with EMAs in a perfect trend, liquid 50s in the perfect buy zone, not overbought. Everything is good here. These are A setups. Hit this with 3%. Hit this with 4%. If the top end of your risk profile is 2%, hit it with 2%. But build the risk profile and identify this, screenshot this as an A setup. I'll give you another one here. This breaks the consolidation here, breaks that pennant formation, because you can see we had a small little uptrend here in the overall downtrend. So we break the pennant formation after a shift candle. So shift, pull back to the 21, break out, perfect liquid 50, EMAs are perfect. So that's an A setup. It's perfect. You see stop would be at the entry candle open price, so about 24 pips, and it falls 2.5R, 62, 63 pips. Very quickly here too. This is the 15-minute on GBP JPY. But why does it do this? You'll say, Austin, how do you find these great trades? I'm telling you right now, use all the parameters, and these trades are there. Identify, is it in the Asian range? Did it break the range? Is the liquid 50 perfect? What about the EMAs? What about ADR? Where are we on the entry candle formation? Is it off the 21 EMA? These are the questions. You should say them in your sleep. If you ask Riley, I probably do say them in my sleep. Here's another one. This is GBP CHF. Look at the liquid 50. This is on the hour chart. First thing you should always look at, liquid 50. It's perfect in the sell zone. It's perfect, right? EMAs, perfect in a downtrend. 2 candle formation is beautiful. 5 a.m., right off the 21 EMA. Stop loss is about 30 pips at the entry candle open price. And look at this thing. Never even breaks the 8 EMA until the next day. 125 pips to the bottom, over 4R. Perfect. A setup. It's a breakout. It's off the 21 EMA. It shifted down the day before. It held the 8 EMA overnight. Clearly could not get above that Asia high, right? See those pins set at the Asia high? Couldn't get above that. Why? Because the liquid 50s in the sell zone and the EMAs are in a downtrend, so everything is telling you you want to sell this anyway. So it's giving you the entry when it's off the 21 like this, and you don't want to let these trades pass you by. That's what I'm saying. When the A setups are there, look, it's not oversold. It's perfect. It's got space on ADR. It's perfect. So that wasn't that many markups, you're probably thinking, right? Well, that's because, like I said a few minutes ago, A setups aren't super often. In the past week or so, I haven't found that many. So when we talk about how often do you take which grade, most of my trades are B setups. So we're going to go into a couple more markups here that are B setups. You're going to see a lot more. Just a couple things wrong with the trade potentially. So the first one here, this is CAD JPY. You can see we are inside the Asian range for this trade. However, it still ends up falling 35 pips. This is a 6-7 pip stop loss because you know this is a little bit of a slower pair. But if you're looking at this, you can see the Asian range overnight right here. We were still inside that range. We hadn't broken to the top or to the bottom. So this was a trade where if you were looking at it, you see the shift candle, but the only thing that doesn't fit the parameters is the fact that it's still inside the Asian range. TDI's in the sell zone. It's not oversold. Everything looked good. ADR definitely had space because you were still inside the Asian range. So you know it still had space. Again, the only parameter that was wrong was it was still inside the box. Again, another one here, similar, right? If you measure the Asian range, here's your Asia high, here's your Asia low. You can see when we enter this shift candle, if we were to take it, you would be entering this as well inside the Asian range. Also here, the 50 EMA, you see that light blue line, is actually underneath the white 200 EMA to start the day. You'd like to see that above, which it does when you enter the trade. But in order for this to say what could be better, you'd like to see it, You'd like to see it in a full uptrend all day. You'd like to see that 50 above the 200 all day. So not only was it inside the Asian range, but the EMAs could have been a little bit better. So definitely at least a B setup here. But again, on a B setup, you take it at 1%. You take it at 2% of your overall balance. You put 10 or 11 pips on this, it goes 40. Look at the rip right outside the 8 EMA. You know that's a good shift candle. Look at the RSI. It's way above the trend line, way through the liquid 50 on that close. So good entry there at 330 on Euro NZD. Another one here. Inside the Asian range, EMAs could be better. You see the 800 EMA is flat across the screen. For the most part here, the 200 and the 50 are above the 800 till later in the day. So when you're taking this trade, you see a nice looking liquid 50, but the EMAs suck. And not only do the EMAs suck, but you're inside the Asian range, because here's the Asia high and here's the Asia low. You're trading still inside the Asian range. So again, another setup that falls over 2R. Look, risking 7, it goes 18. No problem. You can make some money on this, but make sure you're sizing down. Okay? Again, shift candle right there off the 21 EMA is the entry formation. Here, another shift candle, counter trend. What could be better here? The EMAs could have been in full trend. You were trading towards the 800 EMA. The 200 and the 50 and the 8 and the 21 were all in the downtrend, saying, yeah, move lower, move lower, move lower. But the 800 beneath you says that's the floor. Well, it did not care about that. It fell right through the floor, 145 pips, right? 7-1 if you took it the whole way. Most of us, if we were trading this, because you do have a perfect liquid 50s telling you to sell it, if you were short, you would stop at the 800. That's your take profit. You would take the trade there. Still a really, really nice 60 pip trade. It ends up falling way further. That's just the way the market works. But here, weighing this counter trend, you're going to automatically, because it's counter trend, give it the B setup. You're automatically going to give it a B setup. Here, another one, swapping liquid 50 this time and counter trend. You see the 800 EMA on top, right? Swapping liquid 50. Liquid 50 starts in the sell zone and comes into the buy zone. So both of those factors right there would instantly make it a B or a C setup for me. Take the trade. Take this huge 2-candle formation on a breakout for a new high of day. It's a strong bar on a GBP pair. You know that it should probably continue to rise because the liquid 50 is rising, RSI is above trend line in liquid 50. It should continue to rise, and it does. Almost 2R, not even a full 2R. So I would size down. I would be very cautious with trades like this. I would size down, and you'll find a lot more success when you're looking at these. This was another one. Inside the Asian range still, falling liquid 50 too. Look at that yellow line. It's hard to see because I drew a trend line, but that liquid 50 is falling, right? And we hate going long into falling liquid 50s. But price action was rising. The RSI was rising, right? It was inside the Asian range, but it pushed off the 50, pushed off the 21. Your stop would have been 14 pips, and this goes 78, 77 pips. Just destroys, right? Rips higher. This is Euro AUD. So again, you can take these trades, guys. I can't say it enough. You can take these trades, take these setups, but size down. Build the risk profile, adjust your percentages. You don't have to do it the same way I did, the ABC, 2 to 4, 1 to 3, right? You don't have to do that. You can adjust the numbers yourself. I want you to. But once you have it set, build it into the plan and stick with it. This one, again, EMAs could have win way better, but you got a strong bar off the 21 for a new high of day. Perfect liquid 50, but the EMAs could have been better. Size down, 25 pip risk, and it goes 67. There's money everywhere in this market, guys. Everywhere. All day, every day. But if you can have a grading system, if you have good risk management, you can take advantage of it. If you don't, you're eventually going to get caught on the wrong end of a trade. So that moves us now, after we've talked about A setups, B setups, now into C setups. The trick with C setups is that I would really tell you to just don't trade them. Just move on. If I could tell my younger self anything as far as like my trading, redos, it would be to just move off of bad setups, dude. I would smack myself in the back of the head and I would just say move off of it. You don't need it. Here is an example of a C setup. This was a trade that I was looking at the other day. This is GBP AUD, right? This is divergent here on the 15-minute at the 800 EMA with a falling liquid 50 into the sell zone, actually. And it ended up presenting something that on the shorter time frames looked to me like it could move higher. And it did. From my idea, it ended up moving higher. But this is something where you'd look at it like a C setup. You would say, you know what? I don't need this. This could be way better. What could be better about this? Well, the liquid 50 could be in the buy zone. Price action could be above the EMAs, not moving lower. It could be way, way better. So yes, I was right. And that's fine. But if you read my post on Instagram today, we don't care about being right. We care about making money. And these setups are not consistent money. I can show you one here. Look at the divergence here. Look at price action falling, but the RSI rising. It breaks and it presents 33 pips. this was GN on the 5-minute, I was in this trade, and I ended up pulling it for a small win, like 6-7 pips, because I didn't get out in time, because I ignored the divergence, and I was kind of naive to the fact that it wasn't an A+ setup. If you go to the 15-minute, this is the 15-minute of that trade, you can see it's divergent. So not only was it divergent on the 5, it was divergent on the 15 too, and I didn't close it when I was up. And what did that divergence do? It shot it higher. So if you've seen the video that I made on divergence, you know that divergence can cause reversals like that, and that's exactly what you've seen here. So again, let's kind of recap everything here. We want to avoid those C setups. We want to rock hard on B setups, but not too heavy. We want to hit them hard, but we don't want to hit them too heavy because we want to be in them because those are where the money is consistently, but we want to be able to separate from a B to an A. You don't need A+, A-, any of that stuff. You need A, B, C, in my opinion. It's all you need. You got to be consistent with those numbers, though. And again, I would never put more than 4% on the line at once. If I'm going to do 2 potential trades, if I'm looking at 2 GBP like that, I'm never going to do 4% and 4%, put 8% on the line at once. It's not happening. Because if I go down 4% on an A+ setup, I got to reevaluate what I'm doing the rest of the day just because I don't want to break my soft rules, right? My soft stop, my hard, things like that. So again, make sure that this is something that fits you guys. It has to fit you. You don't want to use the same numbers that I'm using unless it feels comfortable to you. This is your risk profile. So to recap again, the questions to ask yourself: is ADR in range? Is that Asian range valid and broken? Are the EMAs in a full trend? Are they kind of choppy? Where are the EMAs at, right? Is the TDI swapping zones or staying in one zone all day? Is the candle formation off a solid EMA? And lastly, is the RSI overbought or oversold recently? And the way that we're going to grade these, A, B, and C. Remember, A setups, nothing can be better. Everything is perfect. You can't find a reason not to be in that trade. B setups are going to be when 1 or 2 of those questions don't answer correctly. When 1 or 2 of the parameters don't line up, that's going to be your B setups. And then the C setups, like I said, 2 or more parameters are incorrect. You probably should not even be in the trade. And just one more time to give you guys my risk percentages for my A setups, 2 to 4%, depending on the pair. I would always make it depending on the pair. And then B setups, 1 to 2%. And C setups, like I said, always less than 1%.